why does anybody say I should have 10 times or 20 times? And the answer always is going to come back to, what do you want to happen? Not what do you need, but what do you want to happen? And if you can understand what you want to happen, what you want your wife and your kids and maybe the charities and the nonprofits and the organizations that you support, what do you want your impact and your legacy to look like? Because guess what? You can create it. All you have to do is make the decisions of what you want it to look like, and then you can reverse engineer a plan to get there. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I want to talk to you about life insurance and really break it down. My guess is if you're watching this video, maybe you're looking to get some life insurance for yourself. So the question is, what type of life insurance is best for you and your needs, right? Now, I say that because life insurance companies and their products can solve so many more problems for you and your life and your personal finances than most people even realize. Now, I am a big believer that life insurance is not a need-based purchase. It is a want-based purchase, because let's face it, if you die, you're not the one who needs the life insurance. It's your family that needs the life insurance. So my question to you is, how do you want their life to look if something tragic happens to you? What do you want their life to be like? I don't know about you, but for me, I want to make sure that my kids get to accomplish everything that they're going to be able to accomplish when I'm here and more. I want my wife to be able to live a life that I'm trying to provide for her no matter what. Now, she's a go-getter and she does real estate investing and she does all this stuff anyway. But the bottom line is, if she's out there and doing that, I want to take whatever I can do and put it into motion so it can make her life much easier. At the end of the day, what happens is there's a lot of people out there, a lot of people in the industry that will tell you, you should have 10 times your income in life insurance, or you should have 20 times your income in life insurance. I'm a big believer in asking why, right? Like, why does anybody say I should have 10 times or 20 times? And the answer always is going to come back to, what do you want to happen? Not what do you need, but what do you want to happen? And if you can understand what you want to happen, what you want your wife and your kids and maybe the charities and the nonprofits and the organizations that you support, what do you want your impact and your legacy to look like? Because guess what? You can create it. All you have to do is make the decisions of what you want it to look like, and then you can reverse engineer a plan to get there. Now, I'm also aware that everybody's in a different place financially. Not everybody is in a place of wanting to contribute to nonprofits and organizations and churches and all this stuff. And you're just doing what you can do to get by right now. And you're just trying to pinch the pennies and get by month to month. And you want the minimum, you want to spend the minimum and get the most death benefit possible to make sure that your family's taken care of. All these things have to be taken into consideration when you look at your insurance wants. And once you understand what those wants are, now you're going to be able to figure out what type of insurance is best for you. And what type of insurance is best for you really depends on what your objectives and your financial position is at the moment. So ultimately, there are 3 different types of policies that you can choose from. And I'm going to tell you what they are, then I'm going to help break down which product is the best fit for different scenarios. Now, the first product is term insurance. The second is whole life insurance, and the third is index universal life. Now, like I said, they all fulfill a different role, and they all basically solve a different problem, right? I mean, ultimately, at the end of the day, I guess they all solve kind of the same problem because there's life insurance attached to it, but the flexibility and the amount of problems they solve varies widely between each product. And so what I want to do is I want to go through each product and I want to break down where the fit is and who they might be the right fit for. Now, first and foremost, let's go with the term insurance. Now, what is term insurance? It's exactly what it sounds. It is a policy that you buy for a small period of time. And when you buy a term insurance policy, you're buying for a term. You can buy 10-year term insurance, 15, 20, 30. You can buy annual renewable term. You can buy return of premium term. There's all sorts of different term policies that exist out there. But the thing to understand with term insurance is that term insurance ultimately is going to get you the biggest bang for your buck because you have the smallest period of time that you're going to have that insurance for. So for example, I'm 41 years old. If I want to buy a 10-year term policy, that is going to be the cheapest amount of insurance I can buy for my age. Now, just because it's cheap doesn't mean it's right for me, but if I maybe am pinching pennies and if I'm trying to figure out what to do to get the most amount of coverage to make sure that my family is taken care of, that the insurance that I want to provide for my family is taken care of, maybe I want to buy $1 million in coverage. Once again, I got to figure out, why do I want that $1 million? That's going to be a different video, and how much insurance I should actually want to be able to figure that out. But when we break this down, if I go get $1 million, I could go get $1 million. Let's just say it's $100 a month right now for $1 million. It's probably actually a little less than that at my age and my health rating, but let's just say for the sake of argument, it's $100. So for $1 million, I could go get $100 a month, $1 million of coverage for 10 years. Now, here's the problem. I'm 41 right now. I'll be 51 when that expires, right? And at 51 years old, if something happens to me and I become uninsurable in between now and then, at 51 years old, I'm not going to be able to qualify for insurance anymore, right? And so I have to make sure that I understand what my insurable needs or wants will be after that 51-year age bracket, right? Because I know for me, when I'm 51, I'm still going to have 2 kids at home, actually 1 in college and 2 still at home. And so I need coverage beyond that, no matter what, to make sure that what I want to happen will happen if something tragic happens to me, right? And so the thing with this is that there is a cost to this, but it's going to be a short window of time. It's going to get the most coverage. And the thing to understand about term life insurance is that insurance companies don't pay out on 98% of policies. So think about that. They know the reason it's so cheap is because it's just that tragic emergency insurance that just says, no matter what, the only way you're going to use it basically is if something tragic happens to you and you die, and they're going to write a check to your family, to your beneficiaries, and that's going to be covered, and you're going to be good to go. Now, that is it. That is it. Like I said, if I needed to buy a 15-year term policy, the longer the term, the more expensive it's going to be. And they typically, you can typically, depending on your age, get approved for up to 20 times your income, no problem. If you want to go above that, you can, with certain circumstances and with a good cover letter and with good financials. And it also depends on how much you make, right? So if you make $50,000 and you want 20 times your income, that's no problem. 30 times your income, typically not much of a problem. But if you're making $300,000 to $400,000 or $500,000 a year and you want 30 or 40, 20 to 30 times your income, that's going to be a much more drastic underwriting process to go through, right? So it's key to understand. Now, that's term insurance. Let's go to whole life insurance. Whole life insurance, basically, what you do is you put your money into a premium and you have a death benefit that goes along with it, but you also have the accumulation of cash value inside of the whole life policy. Now, a lot of people like to bang on whole life and say that it's not very good because it's expensive insurance, and why would you overpay for your insurance? Because in the last example, if I could pay $100 a month for $1 million in coverage, why would I pay $500 a month for the same $1 million of coverage, or maybe even, let's call it $1,000 a month for $1 million in coverage? Why would I pay that much more money to make sure that to get the same coverage? Well, here's the other thing that I didn't talk about in the term life insurance. With inflation going on, and inflation's a real thing, at $1 million, 10 years from now, inflation is going to eat into the purchasing power of that death benefit. So if something happens 8 years from now, that $1 million is not going to be $1 million in today's purchasing power. That's priced into the cost of the insurance for the insurance company, understanding that the time value of money. When it comes to whole life insurance, you would pay more, but while you're paying more, you're also building up cash value, and you're building up a death benefit if you do it properly, by the way. Not everybody's going to design it properly, but if you design a whole life policy properly, you're going to have cash value accumulating that you can have while you're alive. I'm going to talk about that in a second, but you also have a death benefit that's going to continue to get bigger and bigger and bigger. So it actually will grow to counter the negative effects of inflation on the beneficiary's inheritance, right? Now, when it comes to the cash value inside of the policy, this is extremely, extremely powerful stuff. So what I also want to cover here is the fact that when you save up, one of the things that I talk to people about all the time is the fact that I think everybody acknowledges that you should have what we would call an emergency fund or a rainy day fund, right? And so the question is, where do you keep that emergency and or a rainy day fund? And the answer is most people just keep it in a savings account because we just think to ourselves that that's the only place that money can be saved where we have liquidity, use, and control in case of emergency, in case of opportunity. But the problem with a savings account is you're going to lose money to inflation from a long-term perspective. One of the things to understand about life insurance companies is that they are the best managers of risk in the world. And I think one of the biggest mistakes that happens with whole life insurance is people will say this beautiful phrase that life insurance is a bad investment. Never invest in life insurance. And while I actually subscribe to that methodology of thinking because life insurance is a horrible investment, what I will say is it's a misunderstood asset. And life insurance should never be viewed as an investment, but it should be viewed as a savings account on steroids. So what I would tell you is that you can choose to keep your money in a savings account and you can choose to keep your money in a whole life policy. The thing I love about a whole life policy is that it forces you to be disciplined to actually save for your own best self-interest. Now, because most people don't have the discipline to go out and actually save 6 to 12 months in an emergency fund of their expenses, they actually are totally exposed because they don't have this emergency fund put into play. And so by saying that you're going to commit to doing this inside of a whole life policy, not only are you going to put yourself in a position where you can win because you're actually going to save the amount of money that you need to save, and you're going to be putting that money into an account that you have liquidity, use, and control of, you're also going to be putting that money into an account that's going to beat inflation long term and into an account that ultimately is going to be able to have the dollars do more than one function for you, right? So you're going to get the cash accumulation, which is going to be like a savings account alternative, but you're also going to have the death benefit go up. I always tell people that a properly designed whole life insurance policy is the only financial tool in the world that will make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not. So what I say there is whole life, while it's more expensive, it is absolutely worth it if you design it properly and you have your expectations in alignment with the problems that whole life will actually solve for you. It is not going to be a great investment, but if you need your emergency fund set up and you need that 6 months plus of emergency fund reserves, you should put them and save them inside of a whole life policy, because when you look at the value and the benefit of that compared to just a term insurance policy that your term will expire. And this is the other thing I want to say. There's a lot of people out there, the Susie Ormans, the Dave Ramseys of the world, that'll say, well, you don't need life insurance once you can self-insure. Once you have enough money, you have your house paid off, you have enough money for retirement, your kids are gone through school, and all that is taken care of, you don't need life insurance. Well, I got news for you. There's a reason the most successful people in the world that are worth millions and millions or even billions of dollars are utilizing life insurance. It's not because they need it, it's because of the tax advantages and the strategies of passing intergenerational wealth on to the next generations. How do you handle creating your legacy and passing your wealth on to the next generation? You can do it inefficiently by not utilizing life insurance, or you can have life insurance to make sure that you can guarantee what your legacy looks like, right? That is the most powerful thing. Now, whole life insurance will guarantee that you have life insurance in place for the rest of your life that will continue to grow, continue to beat inflation, that will give you living benefits. You can utilize the cash value for an emergency fund. You can utilize the cash value in retirement as what I would call a volatility buffer. You can take the dividends that your life insurance makes while you're in retirement, and you can take that as income if you want. There's so many different things that you can do with it. Once again, it's not a great asset. It's not going to produce tons of retirement income that you're going to want to bank on. But if it's part of a bigger, more well-rounded financial strategy, there's not a more powerful and versatile tool than whole life insurance. And my personal favorite way to utilize it, and the reason that I wrote my book, Cash Flow Hacking, is to utilize whole life insurance as a storage vehicle, as a way to buy real estate and invest for cash flow. Because I think this whole buy and hold way of investing is letting most North Americans down. So that is my pitch for whole life insurance on why I think it's so important. But I do want to take a step back now that I've said that and say, listen, I get it. If you can't afford it, if you can't optimize it, and you don't need to start with $1,000 a month. It could be $250 or $300 a month. You just want to make sure whatever your amount that you do is optimized, right? Now, if you can't even afford that and you want insurance, my suggestion to you is reach out to somebody, figure out how you can get a good convertible term policy. What a convertible term policy means, and you want to make sure it's a convertible term to the right company, with the right company that will convert with the right benefits into the right type of whole life insurance policy. If you buy a convertible term policy, what will happen is you get, let's say, a 10-year term, but at any point in time during those 10 years, you can convert that 10-year term policy, or at least a portion of it, I think in 10% increments with most companies, you can convert into whole life insurance with a properly designed policy. Now, not all companies will let you convert the right way, so you got to make sure you're working with the right companies and that it can be converted to a whole life policy, because there are some that will let you convert, but to convert to other policies that are not going to work the way that you want them to work. So if you do that, you can get the coverage that you need for now and solve the short-term want that you have to make sure your family's taken care of. And then as your financial position improves, as you pay off your debt, as you improve your cash flow, and you can afford to save more money, now you can convert some of that policy little by little by little till you get where you want to go. Now, the third thing that I want to talk about is Index Universal Life. Now, I've got a whole playlist on Index Universal Life. I'm not going to go into this one super deep. Here's what I'll say. Most people selling Index Universal Life are selling Index Universal Life as an investment alternative. Now, I'm not a big believer. In fact, I'm totally against the idea of utilizing Index Universal Life as a retirement income alternative, only because, and here's the big caveat to that, only because most agents have their expectations and are selling Index Universal Life with expectations way out of alignment with reality. Here's my encouragement to you. If you are looking for an alternative to a qualified plan, if you are looking as a way to supplement retirement income, if you are looking for a way to just kind of round out, what I will say is Index Universal Life, while I don't believe it, while I personally wouldn't buy it, and I want to be totally transparent about that, I'm not saying it's bad. If you can wrap your head around and look at the numbers at a 4.5% to 5% return expectation, I don't care what the agents are telling you that it's going to get 6.4% per year or it's going to do this or that. Could it? Maybe on the outside of it. There is upside potential inside of an Index Universal Life. It's important to understand that. Index Universal Life has upside potential. It has downside protection. I've got a whole playlist on it, like I said, that will explain how that all works. But here's the deal. When they say upside potential, it's not upside potential as the way it's illustrated. It's upside potential compared to whole life. It's upside potential compared to the performance of what a whole life policy would do. So, and it really is 50 basis points about is what they bake in for the upside potential inside of an Index Universal Life. So the reason I choose whole life over Index Universal Life is because of the fact that I always think, I guess I'll say it this way. I always look at my decisions thinking about what's the upside, what's the downside, can I live with the downside? And so when I compare a whole life to an Index Universal Life and I go, what's the upside of an IUL? Well, 50 basis points annualized over a long period of time. Okay, what's the downside of an IUL? I could actually lose all my money. The insurance companies can reduce the cap rates, the internal fees and expenses. Maybe the market doesn't perform. Maybe I have loans out on it and the index loans and they don't perform, so that adds more costs. And these things can spiral out of control and the policy lapses on me, or I got to cut a big check to keep the policy in force. I don't want to deal with that. I would rather deal in that situation for me and my risk tolerance and how I want to invest and what my opportunistic investor profile is like for myself. I want to make sure I'm utilizing whole life. And that's why I look at life insurance shouldn't be considered an investment alternative. It should be considered a savings alternative, because that from a long-term perspective, that is what life insurance companies do better than any other companies on the face of the earth is they manage risk, and they manage risk from the perspective of being able to preserve the value of your capital. That just means you're not going to lose the value of your money if you design these policies properly. Index Universal Life is no different than that. And if you understand why and how they do the options trading and how they set the cap rates and how they do the no caps and the proprietary index funds and the multipliers and the bonuses and everything that goes into them, you understand that there's a lot of moving parts there. And ultimately, at the end of the day, there's about a 50 basis point bump that you're probably going to get at best compared to a whole life policy, and there is downside risk. So that is that. If you have any questions at all, go ahead, comment in the comment section below. If you haven't already, make sure you smash that like button, hit the bell or subscribe button, hit the bell. That way you get notified every single time I launch a new video. Hopefully you found value in this. Till next video, have a blessed, inspirational day. We'll talk soon. See ya.